The Hedgeless Horseman here. It's January the 5th, 2023. In this video, I'll again try to emphasize the benefits of thinking much longer term than the market, and how I think that is really the only way to beat the market, because in the short term, beating the market is extremely hard. We make very different decisions if that's our focus. Medium term, beating the market is relatively hard. Long term, if you stick to your principles and sound value investing approach, I think it's much easier, especially in a volatile market. I mean, that's really volatility. A volatile market, again, in the short term, extremely hard to beat. Extremely hard to beat. In the long term, I think it's not only easier to beat than a not so volatile market. I think the returns are much higher than in a not volatile market. But it's all up to us. It's our responsibility, because Mr. Market will do what Mr. Market does. It's our job as always to go left when Mr. Market goes right, and be patient when it's impatient, be, again, the classical thing, greedy when it's fearful, and fearful when it's greedy, etc. So, I mean, let's face it, and this goes for me as well. I mean, one reason I do these videos is to keep hammering in the right way to think, because if you look in the forums and on Twitter and on CNBC or whatever, typically you are bombarded with how everyone else thinks. So if you don't brainwash yourself or isolate yourself like Warren Buffett does, that stuff is going to seep into your consciousness, because you're going to think that what everyone else is talking about as important is what is also actually important, even though that's not really the case, because if everybody's playing the same game, it's hard to beat Mr. Market. But if you play a totally different game than Mr. Market, it's much easier to beat it. But very few play that way. So I mean, I for example recently have watched a lot of YouTube videos with Monish Pabrai. He now and then gets interviewed by people, and he's a pure value investor. He is friends with Charlie Munger and Warren Buffett, and he has had superb results over the long term. And like he says, investing is good if you know. Well, value investing is good if you have hobbies and can find stuff to do in the meantime, because he's certainly not a trader. He checks his portfolio or some stock tickers once a day, perhaps on average, which is totally opposite of how most people, including myself, do it most of the time, and especially traders, of course. I mean, their job is to watch tickers all day, and still I would say that there's not many traders have returns like that guy has, and especially not as Charlie Munger and Warren Buffett has had over the last 60 years or so. But to that point, we all spend a lot of time trying to guess what stock will move higher in the short term. That's just in our nature. That's just how it is, because we are impatient. We want instant gratification. We never want to be in a stock we think can go down. Not even in the short term, because we live in the present moment. This is why we buy high after something has moved and sell low because we think it will go lower. That's how we work. You can check yourself. Anytime you buy or sell a stock, you kind of know why you did it. And if you come up with a short-term reason, let's say that it's not actually that much more rational than, I simply think this will go up and down. Typically, you're doing a mistake, because that's just pretty much guesswork, really. I mean, that's no strategy. That's no fundamental analysis at all. It's just, I have a feeling. That's not really a system because that changes on a daily basis. So again, I recently did a video where I outlined some, I think, mental tools or models to have, which will help you stay on course, stay in the long game, uh, and how from that perspective you'll use volatility uh, instead. And one second here. Yeah, so what I think is the best is like I know it sounds too boring to people, you know, to have a go low. What stock do I think will be, let's say, up 100% in 2 years? We all want 100% next month. That's what most people are actively hunting, 100% within like the next month or two. Uh, and that's typically why, if we expect very good results as a result out of a stock, that's going to get bid up, and no price is too high because everybody expects it to go even higher as the inevitable good news comes out. That's why we, again, many stocks, or especially if there's any risk taking at all in the sector, that's why they get bid up. And when the market, marginal investor expect there to be some negative catalyst, there's no price that is too low. And you can see that's why I actually like, on that note, that's why I actually like investing around times where, well, first of all, sentiment is bad and there might be a negative news release, because typically it's already priced in the negative news, because again, no price is too low in that case, so people will just sell because everybody expects it to go even lower, and that's how people operate. And also during financings, because everybody's definitely scared of dilution for some reason, even though these companies, that's how they create value. I mean, they take in money, yes, you'll get some dilution, but as long as they create more value from the money, which covers the dilution, that's not really a problem. It comes with the territory. I mean, you can't create value if you have no money to create value with. So it goes without saying that companies will raise. But if the market suspects that a company will need to raise, again, that's like a infinite uh, bad carrot that is dangling in front of the market in up until the actual financing has taken place. So a lot of people see a reason to sell regardless how cheap it is, because they expect this financing to come. And that, typically that actually marks the bottom in a lot of those cases. And sometimes again you see a flush afterwards, because everybody gets pissed off that, okay, it actually happens after a downtrend, and some people sell into that. Sometimes it's let's say financing is below market and people sell to get into the financing, so you'll have more downward sell pressure, and that makes people throw in the towel. I mean, I think those are some of the best times to buy ever, because there's so much negativity and so much momentum, negative momentum drivers that come at the same time. So something again that is cheap can get really cheap. Anyway, if you actually were to position yourself like that you have, if you look over your portfolio and you're like, have somewhat of a picture of, do I think this company will, let's say, have created 100% in value, or is going to probably go up 100% in the next 2 years? That's going to look completely different to a portfolio with a focus of, what do I think will do well in the next week or month? Because typically, if you have the short-term approach, you're going to be buying something that is already in an uptrend, typically. And that's closer to some kind of short-term top. And if you have that short-term focus, that means that when it, keels over and goes down, you're gonna sell because all of a sudden you're in a short-term downtrend, and if you had to guess, you would say, I think it will go down tomorrow. So that's how you end up buying high, selling low, over and over and over, for eternity. And that's why most people don't make any money, I would say, actually lose money. One thing, of course, is management starts to be very important, because let's say you think like, okay, pretend that you lock up your money for 2 years. The company's money is being used and distributed by the management team. A good management team will make more good decisions over a 2 year period than a 1 year period. A good management team doesn't have time to make good decisions and create value if you give them 1 day. And on that note, if you had a 1 day horizon, it wouldn't matter if you bought the worst management team around or the best management team around, because the good management team wouldn't have time to set itself apart from the bad management team in 1 day, and the bad management team wouldn't have time to destroy value in just 1 day, typically. But if you gave them 2 years, that's gonna start to show. It's like, if you put me or Michael Jordan in a game and we get 1 second to play each, I don't think it would have any real impact on the game, because even though I would be the worst player in the NBA and Michael Jordan at his prime would be the best player in the game, we can't really change the outcome of anything in 1 second. That's not enough time to let the skill shine through, because you would pretty much just have time to hold the ball. But again, if I played in an identical team versus Michael Jordan, and the only change was that I was playing for the other team and Michael Jordan, I played for my one team and Michael Jordan played for the other, they would destroy us. Over a season, they would totally destroy us, etc., etc. But if we had 1 second each, it would probably be 0-0 from the start of the game. Another thing, forget about how others are doing, and especially any individual play, because we have no idea what people's long-term results are. We can see now and then, people post, let's say, a graph of a company that's gone higher. We don't know if they even had any money in it. We don't know what percentage they had in it. We have no idea what their long-term results are. So it's like, but that is like social media. We tend to point out highlights. I mean, that goes for myself as well. I mean, I much rather to post a chart of a company I own where the stock price has performed well than the opposite. That's just how it is. That's an ego thing. That's you can see that in the forums, especially, even with, totally, or maybe even more with totally anonymous posters. Even though people don't know who we are or know who this anonymous poster is, people want to have some kind of good reputation, even though it's like, well, I mean, if people who don't even know who you are have a good opinion of you, I mean, how does that really matter, because you don't even know each other, yada yada yada. But that's still, from a I don't know how to put it, but I hope you understand what I mean. We tend to want people think good things about us, that we are competent, etc. So that makes you, highlight good cases more than bad cases. It's like I have had a lot of bad cases, or I wouldn't necessarily say bad cases because you can't say that just based on results, unlike how most people see it. That, again, if you play, let's say, aces, and we have no idea what the actual risk reward is in any case. We can only make assumptions, and in the end, after, like, investing over 10 years, then we'll have a good idea if we made more good or bad decisions. But one stock is, nothing to go by, and that's why it's like the worst investor can have some of the best returns in any given year. Give that guy 10 years and he'll probably have lost all his money. So we have to stick with our own strategy, which makes sense at all points in time, and always remember that over 95% of people underperform an index, regardless if they have one or two really good cases, regardless if they have a 10 bagger in a year. Because by definition, some of the riskiest plays can go up the most. And if someone puts a lot of money in one of the riskiest case around, that's probably a mistake, but they can still have a stellar year, 1 year, for example, if only that stock performs well. But give that guy 10 years to put equally as much money in equally as risky stocks, he'll probably have destroyed himself. So we're in it for the long game. I mean, that's the thing. It's like, what is our actual goal? It's the best long-term results we can possibly have. Long-term results. Because let's say our portfolio goes up 100% tomorrow. Is that the end of our investing career? Yeah, if we sell everything, we've made 100%. Let's say we started yesterday in a portfolio, the portfolio went up 100%, and then you sold out. Sure, I mean, your investing career was 100% over one day. Superb. Otherwise, if you're still gonna invest, there's nothing keeping you from losing that 100% or going even into, who knows, debt if you're on margin, etc., over the next year. It's the long-term results that matter, which is made up of thousands of decisions, maybe tens to hundreds of stocks, etc., over that time period. So it's again, the end is that's why it makes no real sense, like when we share or feel too bad about any day's returns. It's like, is that over? Are we if it goes down today, why are we so bitter about it? Are we going to stop investing all of a sudden? Is there anything that says that this stock might not be 100% higher within 6 months? No, but it's just our short-term focus. I mean, that's why I don't celebrate too early, when a stock is up. Let's say you have a stock that is up a lot, but you're still in it. So why would you take a victory lap? Because those gains can disappear if the case goes south or whatever. Same with if you're down. I mean, is it over? Nothing stops that stock from being a lot higher, especially if it's cheap, 6 months. The turtle beats the hare. It's our job to be the turtles. And just to give an example, like, again, if we only had picks, they might seem super boring to people right now, and that's obviously a good thing. But if our goal is like, I think this stock will be 100% higher within 2 years, most people would snooze at that idea because this sector is about 10 baggers and greed. Okay, yeah, it might sound boring, but if you double your money every 2 years, that's a 41.42% compounded annual growth rate. Okay, what happens if you invest 10% and you only try to be in stocks that you think will, on average, return 100% over 2 whole years? In 15 years, with a 41.42% annual compounding rate, that 10,000 will be 1,810,000 in 15 years. That is an incredible amount of money in just 15 years. How many do you see actually? When was the last time you saw someone say, "Hey, I'm really bullish this stock because I think it's going to double in 2 years"? Nobody. I've never seen that. I think never seen that. We tend to form our cases around some up and coming short term catalyst. And it's not even the catalyst after that, it's just one catalyst. Assay results is the most typical. The whole case is I'm buying this because soon there's going to be good assay results out. And I even see that, like, take Magna, for example. I see some, and I think it's, kind of to, lift the spirits or get people bullish. Like, there will be assay results out soon. More assay results from Green Hill. And that's super good and all, but that's not what, in my opinion, the case is for Magna. I'm not bullish Magna because I think the next 9 holes will be good. I'm bullish for what they already have and what the assets they have, how advanced they are. The quality of the management team, that they're basically give them enough time, they'll create value. Potentially a lot of value, given that, okay, it took a while after they listed to get the Green Hill mine, but all of a sudden I think they, tripled or quadrupled the value of the company. That's a good management team. You give them money, they are working day out and day in. They have more at stake than you or I. CEO alone has, I don't know how much he owns of the company, but like 8-10% or whatever, probably a lot of his net worth. He's working every day, even though you don't see it, he's working every day to create value. If you give him 1 day, he might not be able to create so much value. Give him 1 year, he might have created a lot of value, etc. Okay, so now that we know that if you only focus on stocks that you think has a good chance of just quote just doubling over 2 years, which nobody cares about today, and that they are priced as such, that's why it's much easier to play that game, because you're going to be more if your goal was to buy what is again going up in the short term, you're going to be buying something that is already up. You're going to be buying into something that is already in a short-term uptrend. If your goal is if your focus is what do I think will have at least return 100% over the next 2 years, you're going to be much more likely to buy something that is cheap or has gotten cheaper, that has actually gone down in price. Because you look at the price today, which is hopefully very cheap, and you look at where is this going to trade in 2 years. The difference, the delta between the price today and a doubling in 2 years, that's gonna favor the things that are cheap and have become even cheaper. So you're gonna look at volatility completely different. The short-term focus will have you buy high. The 2-year focus will have you buy low. Think about it. I mean, that's if you just put up a star on any stock charts, like in 2 years, my base case is that this will be trading at $4. It's trading at $2. Then that's a $2 difference. If that goes down to $1.7 per share, and you're still like, nothing has changed for the case, you realize, hey, I'm going to get even more. Base case, again, you don't have to be exactly right on anyone. Base case, I'd rather buy something that's at 1.7 that's going to 4 than something at 2 that's going to 4. That's even more than 100%. So you're typically, again, going to be more greedy if you understand the case, because you understand that 1 day or 1 week's volatility doesn't change the case. The catalysts that are going to come regardless if metals are down today and price went down today. It doesn't change geology, it doesn't change the way a good management team is working, etc., etc. It's just short-term noise. So, on that note, if you can get 100% every 2 years, That's 41.42% every year, every rolling to 12-month basis. If you dissect that, that's a compound growth rate of 2.93% per month. Think about that. If you would average 2.93% per month, that's forever. You're going to be insanely rich if you have 15, 20, or even more years, especially because that's really when compounding shines the longer you have. Think about how boring that's going to look. 2.93% per year. People get pissed if a stock is up 15%, then goes down 6% the next day. That is still way higher than 2.93 per month. That would be, I don't know, plus 10% in 2 days. At that rate, you would be compounding at 20,000% per year or something. So have that in mind. It's like if you can average 2.93 per month, that would be a stellar return, even though it sounds so boring. And that's on that point. It's like imagine when you see some company go down 10% in one day on no news. Let's say tax loss silly season. Think about how much just that negative volatility might open up in terms of a opportunity for a buyer. That's 3 months worth of returns, future returns that you got by somebody selling down a stock 10%. So this is one of the hodl portfolios I manage. There's barely any turnover. For the last year, there hasn't been much turnover. The only difference I would say is that over, I think, this period, Snowline was the biggest position. Now, lately, Magna has been the biggest position. And there's it's like tectonic metals in that portfolio. That's up, I think, 200%. I just let it bloom. So far, at least. But then if I find something that is even better than Magna, that deserves the top spot, maybe I'll sell some Magna. Until that, I think Magna is one of the best risk-reward plays out there. And I think Snowline has gone down a bit, but it's still, I think, the second largest position so far, because I don't see, I don't think the case is bad at all. And if you again account for, forget about short terms, like again 2 years from now, do I think Snowline will have created pretty good value? Yeah, I think so. Do I think Magna will have created good value? Very much so. Tectonic, yes, that could create a lot of value. Western Alaska could create a lot of value over the next 2 years. Same goes with Eloro, Line 1, etc., etc., etc. So when you are happy with your portfolio in 2 years from now, that's gonna leave you a lot of comfort and conviction, because that's what you're rubbing your hands together and being greedy about. It's like, hey, in 2 years, I'm happy with all these holdings in 2 years from now. That's the base case. So it's like you're greedy on a future that isn't here yet. You're greedy on what any company you own is going to look like in 2 years. You're not greedy because you think all of your current holdings are going to go up tomorrow or next week or next month or next 3 months, even 6 months. But if you give them 2 years, you're pretty sure from this point, at any present moment, you think the change from now to the future, base case future you see in 2 years, is a very favorable one. You would be very chill about daily movements, because you know that if a stock goes down 8% today, that's not going to change anything, have any impact on what it's going to look like in 2 years. You're going to be more inclined to buy in that case, because you know that the only thing that changed was price. Your future is still very much alive. your base case future, so you're more inclined to actually buy because you just see a bigger opportunity all of a sudden thanks to price volatility. So I really want you to do that. It's like you should know your company or your case well enough that you at least should have an idea how you think the company will look like in 1 year and how people will feel about it, because it's what people feel about it that actually dictates price on any given day. If metals are down, people feel a bit, if gold is down, people feel a bit more negative about any gold stock on that day. And that's obviously noise. But still, it's like we're front running catalysts that people don't care about right now and are thus not pricing in right now. And we're front running what they feel about the company after those catalysts has happened over the next 1 to 2 years. So think about that. If you might be totally nervous on a day that market goes down. And what gets us nervous is because we think it will go down tomorrow as well, and the day after that, and the day after that. But if you think, am I going to have lost money 2 years from now in this stock, given how good it looks? Let's say one of the best examples was like I-80 at $2. It's like, hey, this is one of the best gold developers in the entire space. One of the most de-risked ones, high-grade gold, a lot of silver, multiple assets, sunk costs that's probably 3 times what the actual market cap of the company is. That is just a matter of when, not if, especially given that it's not a crappy management team. So in that case, it's like, yeah, I mean, I think it's a matter of when, not if. If I give it 1 month, I don't know if I-80 is going to be up. Give it 1 year, I'm pretty sure I-80 is going to be up. Give it 2 years, I'm even more sure that I-80 is going to be up. So that's what gets you bullish. It's like, okay, everybody's selling now because everybody thinks price is going to go down tomorrow. Nobody's buying because they think price is going to be a lot higher in 2 years. Otherwise, it wouldn't go down. That's playing a different game. And it's like, take this, if you have a, I mean, for example, this is 101% over 3 years. So that's less than 100% over 2 years. That's fine. That's still very good results. Why? Because 3 years ago, this is where the sector was trading at, using Bear Creek Mining as a sentiment proxy. It's down here. So you're just assume that any time sentiment is way lower over a period of time where you're measuring from, you're going to be, the market is going to owe you money. You're going to underperform. If sentiment hadn't gone like this, going from here to here, if sentiment instead was up here, I think this return here would be substantially higher. If we were at this point still, I think the portfolio would be low, because that would be around here. So even again, it's like we have to factor in sentiment, because that is going to make our returns or cases look worse than they actually are. And we're going to have, at this point in time, for example, down here, the next 2 years is probably going to have us having way better returns perhaps than we deserve. And from this point here, we're going to have lower returns than we deserve. That's why you have to have a longer term perspective, and kind of, I think it's much easier when you understand the swings of the sector. From here to up here, almost every stock would be up hundreds of percent. That doesn't mean that every stock or a case was a good one. And from here to here, almost every case will be down. Doesn't say that your cases were bad or anything like that. It's just how the herd works. And that's why I keep saying, it's like, you should not compare. If you started buying here here, this is when you went into the mining space. And at this point, you think, I'm the worst investor ever. Well, you have very poor timing, obviously. But the only way to be a really bad investor is that when we get back here, if you're still down from having invested here, yeah, then you again have to work on something. But what typically happens is that it's not this that kills people, it's that they're not on board for this. That's the biggest thing. Because it's the rallies that are supposed to pay for the crashes. And if you just average down, I mean, you're going to be fine. But most people sell out here instead of buy more. Because let's say your average was up here, and then you just add. Even though, let's say your average is just down here, let's say, and you're sitting at a big paper loss here, still when that goes up here, you're going to be in the money. The more you buy, the lower it goes, the better it is. The more you can just average down into a crash, the better. If you average up all the time, I mean, at some point, it's going to not take too much to just put you in the red. Because you're buying more the higher it goes, instead of buying more the lower it goes. And it's like, again, volatility. If Magna, for example, if my case for Magna was a beta play, because I only, let's say I have no idea what the company's doing. I don't care what the management, how good the management is or the assets. I'm just bullish because I think nickel is going to go through the roof. Imagine how many times I would just have sold Magna at lows and bought highs. Look at this volatility in nickel price. 38% up, 20 down, 28 up, 18 down, 43 up, 23 down, 34 up, 19 down. And now we had, I don't know, friggin' 15% up and down, whatever. I mean, just imagine how many times, if you're only case, well, if you're either just in for the beta that you just want to get rich tomorrow, or you're in for short-term focused, I'm just gonna buy what I think is gonna go up to tomorrow or in the short term. I mean, look at this trend here. If I had to guess, I would guess that if it's gone up here, my expectations would, of course, it's going to continue tomorrow. And when it continues tomorrow, I think it's going to continue the next day. So I'll buy even more. And when we're up here, I'm going to do the same. So I'm going to be averaging up until, the next profit-taking event or next negative volatility. But if you had, again, a long-term perspective on Magna itself, like, yeah, I think, because let's just look at the fact that, they did the MOU with Mitsui at like $22,000 nickel. They did the definite agreement at like, yeah, also 22. We're up at 29, and recently it was up to 31. So I mean, imagine a margin of safety, implied value of Shakespeare at $22,000 nickel was 64 to 100 million, according to Mitsui. And then they added something that was twice as good. So if we just looked at like the transactions, let's say, one could, argue that Magna is probably at least worth, I don't know, at least 150 to 300 million at $22,000 nickel. At $29,000 nickel should be considerably more. We're not even close to that. We're not even close to that. I don't think we're even pricing in still implied value of Shakespeare at today's nickel prices. And give these guys, what do I think will have happened within 2 years? Unless nickel prices crashes to, I don't know, some level that where toll milling isn't even profitable, I don't know what that would be, and that would be very, very much lower. uh, if nickel does the same, I mean, there's a huge. If nickel stays flat, we have a lot of revaluation to do. If these guys actually create more value, even more evaluation to do in 2 years, etc., etc. So it's like what I'm bullish on Magna about is that it's really cheap now. I think they will create a lot of value over the next 2 years, and today's price to what Magna will look like in 2 years, I think it's going to be super cheap. It's going to look super cheap today, and that goes for a lot of juniors, especially since just from a macro sentiment standpoint, we're here right now. There's a lot of room to the upside. And then we know the supply and demand picture of the metals, which is increasingly favorable. If I did, it's like the HODL portfolio. If I did absolutely nothing for 2 years, I think this will be up from here 100%. Sure, there might be possibly be that, let's say this tops and we actually go down for like, I don't know, 2 years, whatever. I don't think that's going to be the case. Then I wouldn't have 100%. But if that is the final bottom, then you'll have like 600% after that or something. So I think that the long-term average would still be around 100% per year. That's, I mean, again, it's like this HODL portfolio is kind of a testament that you don't need. I don't I don't remember if I did any change. I think I've turned over like, well, Magna was a big turnover. I had to sell some other companies because it's a full investor portfolio to buy Magna. After that, I don't think I've made many changes at all. Maybe 1% turnover in the last month or so. Uh, because why? Why do I hold them? Because I think they will be worth more in 2 years. I'll sell a stock completely if I don't think it will be more valued in 2 years. If it's fully priced or if it can't grow or anything like that. But I'm always having a longer time horizon than the market. But I do enjoy looking at charts and some, technical stuff, etc. It's that I don't typically let it influence me. I just think about what's the base case for this company in 2 years. Take Eloro, for example. Okay, it's been just trading in a consolidation pattern pretty much for 1.5 years. But what's going to happen? In March, somewhere around March, we're going to have a maiden resource estimate. So now everybody can see how much metals they have in their maiden resource at least. That's going to change things. That's going to probably add a lot of beta to the stock, and it's already cheap. I mean, if we have a PEA in, let's say, 12 months from now, and if that PEA suggests it's like, I would guess at these prices it would have a very high net present value. So pressures, I think, are going to be to the upside in the next 12 months, for example, for Eloro. And if they hit at the tin porphyry, etc., I think that's going to be a game changer as well. So I pretty much see major risks to the upside in Eloro over the next year, only the next year. I can see Eloro do 100% over the next year. Not 2 years, but over the next 12 months. Is that a guarantee? Absolutely not. Things can change. But that's my base case, because we don't know the future. It's always risk reward based on a future we don't know. The only thing we know is price. Thanks for listening. I hope you got something out of this. And main takeaways I would say is that 100% over 2 years is 41.42 per year, and 10,000 in 15 years would amount to $1.8 million in 15 years. And that is made up of a compounded annual growth rate, average of 2.93, only 2.93 per month. So you can just imagine how greedy or, well, yeah, how greedy their expectations is that when we get pissed that our favorite case or a good case is not up 20% every month. You can just imagine what the, I mean, let's say 20% per month, let's say 12 months of a year. Uh, yeah, that would almost be a 10 bagger in a year. That's way too much to ask. But that's literally, I think that's actually quite close to the expectations people have. They expect a stock to go up 20% per month. And that's why, I mean, I don't even know if that's enough. Because, like, everybody wants to be in what's going to rocket very soon. And rocket would be more like 50% in the next month. And then they're going to find something else that's going to rocket 50% in a month. So their expectations would be their 10,000 investment grow to $1.3 million in reality in just 12 months. That's absurd. How many percent is that? A lot, obviously. It's like, I don't know, what, 12,000%, maybe 120,000%. Who knows? It's an obscene amount. While in reality, 2.93 average return per month would be superb. Absolutely superb. So think about that when you look at a stock you think is too boring, let's say. That if again, if that stock doubles in 2 years, if you can just continually find stocks that double in 2 years, you're going to be way richer than most people. You're going to beat the market by a mile over the long term. You're going to kick the ass of like at least 99% of investors. Because they're not even looking for it. That's not enough to them. That's why they end up going after 100% returns in a month and blow themselves up over and over and over again, and sell low over and over again, because everyone is trying to guess where a stock is going to trade tomorrow or next week. So if we play that game, we're going to lose. If we play the game where these stocks going to trade at in 2 years and stick to it, we're going to beat the crap out of the market. But as you can see, even in a portfolio where that kinda is working out, you can see how many corrections this portfolio has had. Top tier, it's like over a year of downtrending action before turning up. If I try to trade this portfolio and be in what stocks I think are gonna go up tomorrow or next week, this would probably look like this instead. So it really is a game of patience. Continuously being greedy, because down here I was wildly bullish. It's like here, I said about that. This is the absolute best time to buy because the future is so incredibly bright if we're starting off today here. Incredibly bright. Bear Creek Mining alone went up 200% in just, a month. That's what I'm talking about. It's like the risks are so obscene to the upside from here. But if you were a short-term investor, you would think, hey, I'm going to sell. I mean, look at this downtrend. I'm guessing it's going to be down tomorrow. But if the same person got to see this chart, and it's like, seriously, guess where the mining sector is going to trade at in 2 years? Do you think it will be higher than here or lower? He would be pretty dumb to say, I think it's going to be lower within 2 years. Look at how short of a time frame it actually spends down at these extremes. And there was exactly the same thing happen. I don't have a crystal ball. It's like, just go by history. Yeah, it even plunged a bit lower than that. Pretty basic stuff. It's like common sense. Sentiment is like a Pong game of Pong. Up and down, up and down, up and down. And where we are really skews the outlook for the next 2 years. So from here it's insanely bright. Up here it's pretty bad. but you don't know anything with a guarantee. It's just that, okay, even if I pick the good stocks, there's a good odds if we do a plunge like this, I'm probably gonna be down. But that's okay because if we get there, the future is gonna be superbly bright. So if I have good stocks here as well, I'm gonna make more money on the way up than I lost here. So from this point to this point, I'm still gonna be up. So if you I mean think about it, it's like worst case scenario, yeah, we go into a flush again. But if I can just keep doing this, knowing to buy even more low, stick to the best companies, you're gonna make money. So the even though the sentiment goes like this, your portfolio is gonna go like this. The trend is still gonna be up until the day we die or stop investing. Because let's face it, I mean, I heard or I read that last year was the worst year for investors in 150 years. Overall stock market, bond market. I mean, crypto imploded and all of that. So it's like this portfolio is actually up. So in that case, okay, obviously what you do seems to be working, even though we need more years to fully evaluate it. Still, think about that. Okay, why would I be worried about anything if I get a shitty lemon this year and I can still squeeze out, I mean, I don't expect people to have returns like this portfolio still. Uh, what am I afraid of? The worst year for investors in 125 years happened, and still you weren't down 90% or you didn't blow yourself up. I mean, that basically says that, yeah, you can be invested in any market environment because it's not going to be the worst year in 125 years every year. What if it's the best year in 125 years that comes along? You're going to make a lot of money then. So just by you're winning simply by not blowing yourself up totally when these inevitable crashes come in the mining space. But that's what most people always do. 95% got killed here. 95% got killed here. Not because they were down on paper, were killed on paper. It's because they didn't take advantage of where they were and weren't along for the uptrend. That's how they lose. I mean, being a part in a sector crash, that's nothing personal. It's just how the market ended up developing. It's what we do in response to everything that's happening, the opportunities that are opening up. If you don't understand that this is the best opportunity in 8 years, you're going to end up losing money. If you understand this is the best opportunity in 8 years, you're going to be buying. Simple as that. That's why it's like Napoleon said, you should be prepared. You should have a plan depending on if the enemy shows up in in your front, your rear, your left side or right side. So if a bear market can't kill you, nothing can kill you. So this is, if you survive this, actually did rational decisions throughout this low here, and in my case, for example, I'm waiting for us to get here. So I'm not taking sector profits. Do I know how we will get here? No, I don't know how we will get there. Maybe we'll go down and then up and then down and then maybe it jiggles and then goes up. Or maybe it goes, down and then a straight shot up. I have absolutely no idea. I just know that these companies are still cheap. And if you buy cheap companies that are cheap now, which have a bright 2-year future, the odds are very much on our side, regardless of how the actual path, market sentiment wise takes. Because let's face it, if you own a company that's cheap now and it adds 100% in value over the next 2 years, sentiment has to be a lot even worse than now for it to be trading at a lower price. And it's not going to stay there, because if we go down to an extreme again, eventually that's going to go up as well. Maybe the company has created 200% over that period in time. So it has 200% higher beta, let's say. So when it actually goes up again, uh, you're going to make even more than if it just went from here to here. If it's 200% more valuable, when we go from this sentiment level again to the next, it's going to be worth a lot more than it went from here to here, excluding dilution, etc. But it's like we have to, again, it's like, let's not try to predict the market at any short term period. That's a fool's errand. That's what everybody else is doing. That's why everybody loses money. We play the long game. Hey, this semi-boring stock has a good management team, a good deposit. I think that's going to be a double in 2 years. I mean, that's good enough. Hopefully, it might be a triple in 2 years. That might be your base case. If that pans out, it's going to pay for a lot of other stocks. If we go into the sentiment environment, that might pay for 15 stocks that go south. It's all about risk reward, putting ourselves in the best possible situations where we basically have, if things go very well sentiment wise, we'll do great. If things are mediocre sentiment wise, maybe we'll do good. If we are in a bad sentiment environment, maybe we'll done okay. We'll not be down 90%. How are you down 90%? That's by only piling into supremely risky stories where basically one news release can kill the story and has especially a high chance of happening, like betting it all on a pre-discovery grassroots made an exploration play where they only have one target. If they miss, the story's over. There are some that make mathematical sense in that perspective, but you shouldn't have 50% in that stock. If you have 0.5%, I mean, even if it goes south, like, yeah, big deal. But when it comes to core positions, I really think margin of safety, that it really is a matter of when, not if, that they're already cheap now and you think they're going to be worth even more in the future. That's not the case for a maiden drill play, which has over 95% chance of failure. That's not a when, if, and if story. That's a big if story. But that's what you get when you want to have a 10-bagger tomorrow. You go into the insanely risky stocks. Even though it's much easier to find cases that are probably going to return 100% over 2 years, and given enough time, there's no doubt that you'll make a lot of money. The only thing is, yes, it takes time. That's why crypto is so nice and attracted so many people, because they could go up 1,000% in a month. That of course attracts every impatient instant gratification person around, 95% of people, and that's why they, when the actual bubble, which appears to have topped or bursted, they get absolutely slaughtered because they didn't have a strategy. They didn't want to do due diligence. They just want to get rich tomorrow. So even if you have some dude in Dogecoin, he's up 2,000%. Let's say actually sold, but more sold out of necessity or whatever, didn't really have a plan. He doesn't have any skills to actually make money really, except in a total bubble environment in a trading sardine. It doesn't have any long-term investing skills. So who cares if some guy like that made a 10-bagger? He's gonna go and destroy himself soon enough anyway. And you're gonna be the hare that compounds at like 41% per year, and actually has a strategy that could serve you over the rest of your life. That's why I kept talking about it's like way better ROI to just learn to invest than to try to get rich quick on a Ponzi scheme, let's say. Because one is perhaps going to benefit you in the short term, the other is going to serve you for life. Thanks for listening. Assume I'm biased if I talked about any stocks. Not investing advice. Do your own due diligence. Don't invest money you cannot afford to lose. Bye. Thanks.